So as the GIC College of Central Bankers evolves, if any of you would like to work with us on moving this initiative forward, we would greatly appreciate your input very, very, very much. So at this point, I'm delighted to invite Charles Plosser to the podium for a few remarks. Thank you.
Well, good morning, everyone. And first of all, I want to thank the GIC for inviting me to serve as a member of the College of Central Bankers. I'm honored and flattered. And although there are some who might argue that my appointment to the College of Central Bankers is because I need remedial training of some kind. There's probably those out there who share that view, but I'll just look on the bright side, right? So I am delighted to be here. I'm also delighted to be here because the GIC should be congratulated for the scope and breadth of its events that it's worked on for the last 25, 30, 40 years, however long it is. And their geographical reach and topical reach have been extraordinary from my point of view. So congratulations to the GIC for its and board for all its efforts and contributions. Now those of you who know me, and some of you may be among those who say I need remedial training, know that I can be provocative at times, and this I think will probably be no exception. So, but that's what I like to do. So my starting point for my brief remarks today is the premise that political independence is an important pillar of sound monetary policy. Now, the case for independence of a central bank is largely an empirical one. History is replete with examples of the undesirable outcomes that occur when monetary authorities become overly or excessively politicized. So while independence for a central bank is crucial, in a democracy, that independence must be accompanied by constraints on the breadth and scope of authorities that the central bank has. That is in order to ensure that the central bank is accountable. Without those constraints, my belief is that independence is simply not sustainable without some constraints. Thus, institutional arrangements and frameworks matter, including monetary policy strategies, policy choices, and operating regimes. All can make a difference. The choice of such arrangements, policies, or regimes can act to support or undermine central bank independence. And it's along these dimensions I'd like to focus my remarks. Now, the current environment makes these concerns particularly relevant, I think. Central banks around the world are facing challenges to their credibility and effectiveness, and more importantly, they're facing challenges to their political independence. It's under scrutiny, and in some places, outright attack. Now, it would be convenient to believe that these threats are entirely external in nature. They are external threats to the central bank, and indeed, many of them certainly are. Unfortunately, I believe that some of the challenge stems from self-inflicted wounds that have enabled these threats to grow and flourish. While the Fed cannot always control the political environment in which it operates, it should seek to avoid undermining its own credibility and the case for its independence through its own actions. Regrettably, as I alluded to, I think the Fed itself has taken actions that risk undermining its own case for independence. So I want to briefly discuss three examples. One related to strategy, one related to policy, and one related to an operating regime. First, from the standpoint of a policy perspective, the Fed, in my view, has been too willing to accept responsibility for real economic outcomes that go beyond its capability to deliver. and in some cases beyond its mandates. Second, I believe unconventional policies have broken the traditional boundaries between that separate monetary policy from fiscal policy, and thus inviting political interference. And third, its choice of a new operating regime that untethers the balance sheet from monetary policy has opened a door to political abuse of its balance sheet. First, as to the expanding expectations for monetary policy, I'm often reminded of a teacher of mine, Milton Friedman, who in 1967, I wasn't a graduate student then, but in 1967 in his presidential address to the American Economic Association said, and I quote, "We are in danger of assigning to monetary policy a larger role than it can perform, in danger of asking it to accomplish tasks that it cannot achieve, and as a result, in danger of preventing it from making the contributions it's capable of making." Friedman's warning in 1967 was prescient. The 1970s saw an aggressive attempt by the Fed to influence and control the real economy, and unemployment in particular, resulting in inflation rates that reached double digit, as we all know. After Paul Volcker, who sadly passed away this week, as many of you may know, after Paul Volcker regained control of inflation in the early 80s, monetary policy makers tended to exhibit more restraint towards the feasibility and effectiveness of such stabilization efforts, implicitly acknowledging Milton Friedman's warning and wisdom. Unfortunately, with the financial crisis and subsequent recession, the Fed and the public seem to have returned to what I believe is the mistaken hubris of the 60s and 70s. Fine-tuning the real economy is back, albeit dressed up in fancier economic models and calls for financial stability. Accompanying this fine-tuning revival has been a growth and intervention, both direct and indirect, by central banks in a variety of markets, but especially financial markets. Unfortunately, the capability of monetary policy to engage in such successful fine-tuning remains elusive. Thus, Friedman's admonishment seems to me to be as relevant today as it was 50 years ago. We ask more and more of our central banks. Governments seek to avoid difficult choices of structural reform or addressing sustainability of their fiscal policy or the unintended consequences of their regulatory actions. Yet they expect central banks to offset their ineptitude. We often hear pronouncements that monetary policy should seek to address weakness in real wage growth, low labor force participation rates, income inequality, climate change, or the prospects for future trade policy at home and abroad, and the list continues to grow. Yet monetary policy has limited, if any, ability to influence these challenges, even though monetary policy may have to react to the economic consequences of these actions, these events. The extent to which central bankers themselves implicitly act or say things that can be interpreted as that they are concerned about these actions and will seek to do something about them, again raises the mistaken view that the power of monetary policy is infinite. This broader view of the role of monetary policy invites politicization and the shifting of accountability from government to the central banks, undermines the central bank credibility when it fails to deliver the desired outcomes. Second example is the adoption of unconventional monetary policies has also contributed to the threats facing the Fed. These policies raise concern because they broke the traditional boundaries that separated monetary from fiscal policy. Two examples I have in mind here, generally, is that, and we all know them, the bailouts of Bear Stearns and AIG during the crisis, which were overtly fiscal policy actions, and the huge quantities of assets, particularly MBS assets, mortgage-backed securities, bought during what we call QE or LSAPs, large-scale asset purchases. This growth of the balance sheet by non-sovereign debt has been important, and it's a form of credit allocation. That is to say, the MBS purchases were a direct attempt by the Fed, admittedly, to influence the housing market in particular. So it was credit allocation. So whenever the monetary authority acts to usurp the powers of the fiscal authorities, it is not at all surprising to see increased political pressure on the institution. Indeed, such actions actually are an open invitation to such scrutiny. Finally, the Fed has now adopted an operating regime for monetary policy commonly called a floor system. This system has several features, some of them good, some of them bad. But the key element I want to emphasize for my purposes is that under this regime, the Fed's balance sheet is no longer tied to monetary policy. The primary instrument in a floor system for monetary policy is the interest rate paid on reserve. The balance sheet, or the volume of reserves, is really not crucial to the conduct of monetary policy as long as demand for reserves is satiated at the interest rate paid on reserves. In adopting a framework where a large volume of excess reserves becomes a standing feature of the operating regime, the Fed is opening the door to political interference and threats to its independence. Once the demand for reserves is satiated, there is no limit, in principle, to how big the balance sheet or volume of reserves can be. A large balance sheet unconstrained by monetary policy is ripe for abuse. Congress and the administration would be tempted to look at the balance sheet for their own purposes, including credit policy, off-budget fiscal policy, and other matters. Imagine future confirmation hearings of Fed governors could take on an entirely new form or focus. Senators would likely be very interested to know how a prospective governor will view the asset side of the Fed balance sheet. There could be questions regarding how the Fed should diversify its portfolio out of treasuries, let's say. There would be questions about seeking support of the Fed for funding particular fiscal initiatives, such as an infrastructure bill, or perhaps the Green New Deal, or support for failing state and local governments. The off-budgeting of the consumer, the off-budget funding, I'll get it right in a second, the off-budget funding of the Consumer Financial Protection Bureau in 2012 and the use of the balance sheet to fund a transportation bill in 2015 are but two examples that foreshadow what I think may be coming. For those proponents of modern monetary theory, as it's called, or MMT, this free balance sheet is manna from heaven. This would not be what the Fed intended of its ample reserve regime choice, but it may well prove to be the most disturbing outcome. My point is that the Fed can at times be its own worst enemy. It has frequently accepted greater responsibility for real economic outcomes, even when monetary policy has limited ability to influence such outcomes. You recall President Draghi's, the ECB's comment about, we'll do whatever it takes. Well, but what if whatever you've got can't do it? You got a problem. Unconventional policies have blurred the traditional boundaries between monetary and fiscal policy. An operating regime that decouples the balance sheet from monetary policy is a choice that is ripe for political abuse and political interference. So my own view is that it's a time for the Fed to be a bit more humble, and other central banks as well, about the capabilities of monetary policy, and to steer away from fiscal actions that invite political scrutiny, and to reconsider its commitment to an ample reserves operating regime. It needs to take more seriously the threats to its independence, and how its own actions and communications might undermine that credibility and the case for independence. Losing independence would be an exceedingly costly outcome for our economy, and would be extremely costly and difficult to regain. Thank you very much. If we've got time, I'll be happy to take a few questions. Thank you. Surely I didn't arouse somebody's ire.
Thank you. You've argued strongly that the balance sheet should change. Do you think it will change under this adversity? And if not, are we heading for MMT?
Yes, I think it is reversible. It's possible. Is it likely? Perhaps not. Central bankers, Paul Volcker once told me, in fact, he was right here in Philadelphia near the end of my term, and he was giving a talk to us. And I was having a conversation with him in his office, and he said, you know, I learned a lesson from Montague Norman, or was it Morgan, not Montague? I can't remember. It's Montague Norman, I think. He was the great governor of the Bank of England for many years. And he said central bankers should never explain and never apologize. So my reaction to Paul's comment was, well, Paul, I'm afraid that never explaining is kind of out of the box. We can't do that. Never apologizing, well, they're still pretty good at that. So I guess I would say that for the Fed to reverse course, it's going to be difficult. It's already difficult because maintaining a large balance sheet even now is kind of counter to some of the arguments it made during the crisis when it said we need a big balance sheet for more monetary accommodation. Well, now we're going to have a big balance sheet because we want all the excess reserves or all the reserves in the system. What does that have to do with monetary policy? Is it now providing more accommodation? If so, how are we going to set the interest rate? The Fed's never answered that question. They've never addressed that issue. So, so they kind of want to have it both ways. They kind of want their cake and eat it too. So I think it would take a real effort for them to fix their communications in a way that would allow this. It's not impossible. I think what may allow them to do it might be ultimately some kind of crisis, where MMT, when Congress then says, here's what we want you to do. And then it's going to be hell to pay, and it's going to get pretty nasty, I think, about how then the Fed unwinds from that. Because part of my point is that the Fed, either in statute or in practice, needs a mechanism for saying no. Ben Bernanke gave the right answer when Chris Dodd and Chuck Schumer wrote him a letter in 2008 and said, we'd like you to bail out the automobile companies. He said, no, that's not our job. Well, it's not outrageous that a congressman or a senator might think that when the Fed had just rescued Bear Stearns and AIG. Where do you draw the line? The Fed needs some mechanism on its own where it can justify saying no. And when it doesn't have a, if it divorces the balance sheet from monetary policy making, how does it say no anymore? And Congress or the administration or somebody is going to look at that and say, well, you know, California and Illinois are going bankrupt. We need you to buy those bonds or green bonds or whatever they call it. It may be government securities of some point. But what's wrong with adding another $500 billion to the balance sheet? How do you say no to that? So I think there needs to be some protections built in the Federal Reserve System that allows that.
So to follow up on that a little bit, in theory, what is, so if you think about California or Illinois and where interest rates are and MMT and all of this, What is so wrong with adding 500 billion to the balance sheet? If rates are low and the bond market's working well, is the idea that it's great until it becomes really, really awful and then it just, the whole system kind of falls in
Well,
on
I
itself? Or, I'm just, if someone would say, you know, what's so bad about that right now? If California needed $500 billion right now?
Why don't we just print it?
Yeah.
Well, good luck on the outcome of all that. Where does that stop?
Yeah.
How do you justify saying no at some point? As a way of illustrating that this is not quite as fanciful as you might think, the Swiss National Bank is facing exactly this. The Swiss National Bank has a very large balance sheet. It got into that situation because of its peg to the euro and its challenges to keep the Swiss franc under control and not hurt their export markets. Now, Thomas Jordan, who is the director of the Swiss National Bank, actually a former student of mine, Thomas Jordan is now facing calls from the Swiss government to use its balance sheet for all sorts of purposes. To buy green bonds, to buy stocks in Swiss companies. And most recently, he was asked by the government to fund the pension plans of the federal government, or the cantons and federal government. Now, in that last case, he said, no, we're not going to do that. But this is playing out in real time elsewhere. So I think that, again, it's about what are your constraints? When I said central banks need constraints, those constraints are needed to protect their independence. And so other places around the world, central banks, think of Argentina, other people who have used their central banks as a mechanism for fiscal policy have come to no good. The Central Bank of Argentina, the central bank president was fired by Christine Kirchner because he wouldn't turn over the reserves to the government to fund fiscal deficits. She fired him. At one point, it got him to retire, and next thing you know, they've got 25%, 30% inflation. So this is a very dicey. This is not pure, simple economics. This is political economics. But it's real, and it's playing out in other places. It has played out in other places around the world, and I think that the Fed, again, this is just my view, is not as sensitive to these risks as they maybe should be in doing more about it to protect themselves. The Fed tends to have, I guess I would call it a complacency about the political economy issues that says, oh, we're right and therefore it'll work out. Well, maybe it will. Maybe we'll muddle our way through this without drastic consequences. But it certainly makes me nervous, and I've been nervous about this for a long time. I mean, Dennis knows I've spoke about this back when we started QE, which was, how do we get out of this and what are the long-term consequences? I am saddened by the fact that those predictions are, at least the risks seem to be rising rather than falling, but I think it's cause for concern. Okay.
The quick question, or maybe not so quick. Do you see anything on the horizon?
Just 1 second, let's have a microphone. Thank you.
Do you see anything on the horizon similar to the Bear Stearns bailout or the mortgage-backed securities?
Well, one good piece of information. The Fed has made it clear, or at least said, it doesn't mean they'll stick to it, has indicated that as they look forward, I'm pleased about this, is that they want to return to an all treasuries portfolio. I think that's a very wise decision and would help some of these concerns about credit allocation and other things. I think the Fed would, where they was push come to shove, they'd probably go back to MBS purchases if they thought that would be valuable. But I think their inclination is to want to go back to all treasuries as opposed to a more diversified portfolio. I'm sorry, the other question was,
Just so you can see something on the horizon.
oh, like a
Similar
Bear Stearns?
to- That
No,
would shake the economy.
no, well, there are always things that can shake the economy. I think the biggest risk these days is sort of uncertainty about policy, particularly trade policy is a really important risk. I think it's vacillated from good news to bad news depending on which month you pick up the newspaper, which is part of the reason why I think it's bad to base policy on, you know, what may or may not happen in that dimension. So there certainly are risks, and there will always be risks. So I can't do anything about those. One more, Peter, should I wrap this up? One more?
One more
Okay.
question.
One more? Where? Oh, okay, back to the back.
Go back there, I'll.
President Plosser, in light of central banks having a tendency to overstep their bounds into doing what the fiscal side should be doing, how would you counsel your European counterparts at this stage of the game? How can they, what should they do to quote unquote say no?
We usually ask Christian. I don't know. I would have thought, well, first of all, it's different in some ways. I would have thought, and Christian can speak to this better than I can, the European Central Bank had a constitution that tried to protect its independence. And back at the height of the Greek crisis in particular, the European Central Bank decided to, correct me if I'm wrong, Christian, but take a step beyond their constitution and ultimately had to go to the European Court for this and get approval for some of the actions they took. There's a little difference there because European Central Bank doesn't have just one country to answer for, and so its governance structure is a little more complicated. I think independence is just as important for the European Central Bank as it is for the U.S. Central Bank. But because of their governance structure, the mechanisms for doing that are a bit more complicated. And but having said that, I would say if I were at the European Central Bank, I'd be deeply concerned about politicization of the central bank, of the ECB, and how it's playing out and has played out over the last 10 years. I think if I was them, I would be troubled by the same sorts of issues and wondering how are we going to get out of this. If the governments of the European Union won't address the structural and fiscal issues they need to address, you know, how is the burden ever going to be lifted from the central bank being their scapegoat to sort of provide backup, if you will, for their intransigence, I guess is one way to put it. So if I was the ECB, I'd be concerned about this and wondering where all this leads.
So we don't want to put you on the spot. But would you mind taking the microphone and just making a comment or two?
Yeah, that would be great.
But there's Christian Yoret, who is one of the fellows of the College of Central Bankers, was key, for those of you who don't know, in the period of coming out with and structuring the euro for Europe and leading that initiative.
Well, thank you very much indeed. Just to add a few, I very much agree with you, Charles. I think there were two things in what the ECB did. One was the famous whatever it takes. In fact, that was at a point of time where the markets, or part of the markets, were playing against the euro. So the central bank was confronted with the risk that the currency it had to defend. In the end, the guardians of once Alan Greenspan said in the BIS when he was ask what is the ultimate goal, mission of the central bank. Say, in the end, you're supposed to guard your currency and make sure that it survives. So there was a point of time where it was not only Greece, but the market was starting to play the disruption of the whole euro area. So that's why the ECB stood up. And by the way, it never used the instrument that we designed at the time, because the markets calmed down once the central bank said, we're going to fight you, markets. And you never fight the Fed, you never fight the ECB. If you really want, it is determined. Now, on the QE, which is a more fundamental issue, I also very much agree with you. I think there was a difference, or there is a difference between two periods. First period when QE started in America and in Europe, there was a fear of deflation. And really, avoid a deflation seems to me to be fully in line with the mandate of the central bank. So if central banks have gone to zero interest rates, they had to find ways to avoid deflation and be improving their mandate by other means. Nobody liked to use QE because of the risks on central bank independence that were seen. But at the time, we didn't find another way to do it. And going into negative territory, I'm not going to. It would be too long to comment on that, but I've never been very happy with it. Anyway, doesn't work so well. So that first period, I think you could. There are strong arguments in favor. Second period is once you got out of the risk of deflation, because your inflation, your core inflation has moved over 1%, for instance, and you are relatively safe from deflation. The risk is to use QE for fine-tuning, as you mentioned in your talk, and that's there's a lot of risks. And I think towards the end, Mario Draghi led his governing council committee much too much into fine-tuning of inflation growth, and that's where in fact the really should have been taken.
So the level here will be for the next guy.
Thank you. Thank you, Christian. Thank you.